So we're back to our super region, and wanted to kind of show you what the numbers look like. So here's a typical real estate pro forma that we this is just recently, less than a month ago. This was the numbers that we were looking at. House is 218,990, 1,627 square foot, 4-bedroom, 2-bath, 2-car garage, brand new. 2.29 tax rate. Most tax rates we're looking at are between 1.6 and 2.4. So 2.29 tax rate. And so you're looking about we put 30% down on this pro forma, which would be about 65,000 plus your closing costs. You're looking about 70K to get into it. Or if you were looking at your cap rate or your cash on cash return, you're looking almost 6%. It's hard to find 6 caps anywhere, especially in new construction anywhere in the United States. So take note here that the cap rates here, and especially you're not going to have any really negligible amount of capital expenditures like having to replace things and doing that because it's all brand new. Of course, you also have the 5.75% interest rate, which is now in some places 5.5. Plus, they also pay a couple points in closing costs. So the builder pays not only closing costs, but they also got this incredible interest rate, and they're giving you at wholesale prices. That's the sweet spot. That's the opportunity. That's why we're so excited. That's why our clients are excited. So I took this performance. We could do performance on all of our properties. I just took the chunks here and broke it down into the 4 quadrants here. You have your numbers here: 1,627 square foot built this year, 422, 2.29 tax rate, 469. 4694 in annual taxes. Insurance about 500. Insurance is low on new construction, so people question that. I thought it'd be more like 1,200. No, new construction that's between 500 and 600. Put in 5,000 in closing costs because even though the builder is paying costs, it doesn't cover it all. Your HOA yearly can range anywhere from $300 to $700-800 a month, or a year, not a month, per year. So you're looking about 30 to $50 a month. When I do an annualized what the leasing fee expenses plus management fee expenses, maintenance is very low on new construction, and then a vacancy factor, and we plug those numbers into to get the cap rate. So here's your cap rate. We used your the annual taxes, the gross income minus the annual taxes, the annual insurance, the HOA fee, the annual management fee, and then the annual maintenance, leasing, and vacancy. These numbers here are actually based on the management and leasing is based on a 2-year, not 1 year, because people don't move every year. They can, but they don't usually. Usually our usual stay is 3 years. So I do a 2-year annualized, and that's where we get the fee here. And then you're looking at a net income of over $1,000. I mean, if it was free and clear, it'd be over $1,000 a month. And then 5.79 cap rate is unheard of in new construction. So here's your numbers at 575, 153 loan amount, 1327, rents around 1850, going to run around $309. Wintertime, the rents maybe $100 less than that. Summertime, they can be $100 higher than that. So you want to get everything on the summer cycle, and we help coach you with that, and your property manager knows. We try to get the leases to renew sometime in between May and August. So back to the days of cash flow, which has been hard to find anywhere. Okay, and then we have investment summary, kind of showing you the numbers, how we come up with our investment of the equity. So this is taking the cost $70,000 to get into it. And we're also coming in with appreciated value, because these homes that we're buying at 218, we were selling, and we were still very happy. People were buying at 242, but you had an instant bump in equity by those appraisals are coming in higher. And then as the value goes up at 5, we're just using a 5% appreciation, and then your loan balance goes down over time. Of course, slow at first and more accelerates as you go through the loan. But every year, within year 3, you've had 100% return on your initial investment. So that's really, really hard to find in any kind of investment type of situation. So, and over time, you get out to 10 years, you're looking at 312% return. And you still have the asset, and the tenant's been paying the mortgage the whole time. So, but real estate's great.